quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, Corporate Treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode. Welcome to the Corporate Treasury 101 podcast. This is the second part of our full interview with Matheus Zani, where we discuss how to manage FX in Latin America. In the episode of today, expect to learn: do countries in the region employ similar FX risk management strategies despite their economic differences? Are there any success stories or notable failures in FX risk management in LATAM that serve as key learning points? Why is hedging essential in Latin America, and how does it differ from other regions? How has the FX risk landscape evolved over the past decade in Latin America? And like always, much more. We truly hope you enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help more people learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. And with all that being said, please welcome Matheus Zani.
Yeah, exactly. And so how is this, that's a perfect transition. How is this inflation in Latin America overall, how does it affect treasury activities beyond the obvious example of the crypto?
Yeah, I would say for companies that work in the retail sector, inflation can change very rapidly the cost of the good and also how they sell it to the retail buyers. So this environment of the high inflation, very volatile inflation, adds a lot of complexity in the treasury for all the departments of the company. The buyers, the sellers, the pricing team, and of course the CFO that manage all the cash flow of the company. So high inflation is a very it's a very difficult component to quantify in terms how we can work with these numbers and maximize my cash flow in terms of maximize my profits and reduce my costs. It's very, very, very tough to deal with inflation. And the result of the inflation is, as we discussed earlier, is the high interest rates. High interest rates will lead to a higher borrowing of costs. So companies not only need to deal with the inflation in one point that is sell their mercancy, but also how to manage their cash flow in terms of liquidity of the company, how much I need to finance my liability in order to have a cash flow, a proper cash flow of the liabilities and assets at the same patamar. I think this is the idea.
Yeah, makes a lot of sense. So maybe going a little bit deeper into navigating the foreign exchange landscape in Latin America. How does each country there differs in terms of its currencies regulation and challenges? What have you seen there?
Yeah, indeed, Latin America countries exhibit very diverse currency regulations and challenges. Now, for example, Brazil is as one of the largest economies in the region, has its own unique currency, not the Brazilian real, as we mentioned here many times already, and a very complex economic environment. In contrast, Argentina has faced a recurring currency crisis in the last year, very strict capital controls. Chile, on the other hand, has more open and stable foreign exchange market, make it distinctive from its neighbors. But yes, each country has your unique situation. We cannot, in any possible way, to generalize all the environment of the Latin America. It's just one sort trend or just one sort regulation or change. Each country has your unique situation.
And I guess the FX risk management, again, coming back to the effect of that for treasurers and people doing treasury operations, Matheus, people look at LATAM as just LATAM, right? It's South America, or Latin America. But if the situations are so different in terms of currency control and regulation, is the FX risk management for that also very, very unique? Or like, can I, in one sentence then, right? My question, one sentence. If I'm a global treasury manager, right, with a company that's working in all the different regions in the world, can I realistically divide up the world into LATAM, USD, Euro, and Asia? Or do I need to, if I'm doing business in multiple areas in LATAM, do I really need to have a very specialized, tailored FX risk management strategy for each country I'm operating in LATAM? Or can I generalize? Or is it as different as doing business in Argentina as it is in Peru, as it is in the US versus Europe?
Yeah, that's a very good question. No, I think you cannot generalize your FX risk management approach. I think each country has different market environments or market conditions. So we need to take this in consideration to put together a very solid FX risk management program. Why? Even though all the derivatives are the same in superficial lines, I want to say we are able to access liquidity for NDF, which is a non-deliverable forward. You have forwards available, options available, cross-currency swaps. In general lines, you are able to put together a hedging strategy using this instrument. But how you deploy, how you build this hedging strategy, you differ country by country. Okay, for example, I cannot, let's say, book an ETF for 24 months in Peru, but I can do this in Brazil. Why? Because in Brazil, the market is cheaper than in Peru. Okay, so we need to understand this liquidity, how far I can go with my hedging strategy. Or another example, I can place options. I can buy vanilla call put or some other option structures in Chile, but I cannot do this in Peru. The same thing. I don't have liquidity for these instruments. In Brazil, I may be able to go 24 months, 18 months out using options or using a cross-currency swap. But we need to understand how expensive it is. Maybe it's cheaper to do a short-term hedging and roll over the position to match the effective cash flow. Because we are able, you will be able to minimize your cost doing short-term hedging rather than long-term hedges. Okay. But in Colombia, I can go 24 months and it might be cheaper than in Brazil real. So of course, this is market condition that can vary every single day. But these nuances that the treasury team must be aware. The instruments are the same, but the market conditions are completely different. You have each country has different volatility, each country has different treasury rate differential, each country has different liquidity to access these products. So in the end of the day, what you are doing in country A, you'll be very, very difficult to replicate for country B or country C. So each country has your unique market conditions, and therefore you have a different risk management program and approach for that country.
I mean, you've been doing this for a decent amount of time now, Matheus. Do you have any good examples of like FX risk management strategies you've seen implemented in this region? And it would be interesting if you give examples specifically on the dangers of generalizing LATAM versus the successes of specifying your FX risk management strategy across different countries in LATAM. Do you have any examples you can share with us of like success stories?
No, for sure. I can say mainly in Brazil, where our clients are based right now, because we have such a high interest rate differential, which is a higher hedging cost, that deploying NDFs to hedge the currency risk can be quite expensive. For those firms that need to be long dollars and sell Brazil real. So we performed like many analysis simulations here, where we were able to showcase that hedging through NDFs will be much higher, with while hedging with option structure it would be cheaper. Because the way that options are priced takes into consideration three main components. The first one, of course, is the interest rate differential. The second one, the volatility of the currency pair. And the third one is the time to decay, the time to the maturity of the contract. So when we analyze NDFs, the first component is the only one that price NDFs, the interest rate differential. Okay, so if you want to hedge for exposure 12 months out, using NDF is much the cost will be higher when hedging through options, because it's the three components. We can try to optimize the strikes of the options, and the same time that we are able to cap the downside risk, optimizing the strike, we're able to have some upside participation. Of course, depends on the option strategy, but options offer this flexibility to manage the currency risk. And so because we are able to have this upside participation, and with the downside risk kept, we are able to reduce the hedging cost. So this is one of the main points. And another advantage using options, because they are less sensitive to market. So let's say if the currency change 10% with the NDF you show 10% mark-to-market, negative mark-to-market. But with the options, will not be the same thing. Okay, so for those companies, businesses that face some liquidity constraints, options are a better alternative solution, okay, rather than using NDFs. So as I said, also depends. We need to understand the risk profile of the client. We need to understand the goals in this hedging program that the client wants to build. And at the end of the day, the hedging strategy will be completely tailor-made, taking consideration the market conditions and the risk profile of the client.
And that's an interesting one, right? We understand that it's a bit hard to pinpoint a failure in FX risk management in Latin America, but one of the things I can think of is typically the idea of FX management is to mitigate the risk, right? But when you are in the case of a country in Latin America where you have particularly high inflation, it also means very high volatility in your FX rates, right? So you can be hedging, but ending up having an ultra negative mark to market because you could have made so much more money not hedging. The other one I can think of is when it comes to credit lines hedging. Typically, corporations might be interested into hedging their liabilities in Latin America, right? As a European company or an American one. Here again, to just make sure, okay, we need this credit line in Chilean sol and not peso. We cannot circumvent it, but what happens in case Chilean peso goes through the roof or the other way around? And here again, it comes down to how well and how much do you want to protect yourselves against such uncertainty, right? But a super interesting one, Matheus. Thanks a lot for that. You've touched upon it a lot, so let's dive into it. Can you quickly remind what FX risk is for our audience? So just disclaimer, we've done quite some episodes lately around FX, but just a quick reminder, and try to explain it if possible within the Latin America context.
No, it's always good to revisit some terminology and approach. Pretty much FX risk is the potential loss, but also the potential gains that a company may have and may experience due to the currency fluctuations. I like to say that risk doesn't mean only it's a problem. The risk it's not only your enemy, but you can take advantage of the risk. Risk can make your revenue more profitable, or you can see your revenue lower due to the currency fluctuation. So currency risk is both. Is the potential loss that you may have due to the currency fluctuation over the time, but also potential gains due to the currency fluctuations over the time.
Crystal clear. And so why is foreign exchange risk management such an essential part of corporate treasury when it comes to Latin America? Like, obviously we've teased and talked about it already, but can you summarize why it's so essential in this particular region and how it differs from other regions?
Yeah, I'll give you a very clear example. If you take the Brazilian annual volatility in the last 12 months, it was around 16%. If we run a volatility risk at a 95% confidential interval, in a cash flow, let's say $100 million for 12 months, this volatility risk will be $26 million of losses. Okay, so in a portfolio, a cash flow of $100 million, your potential loss will be 26% of this amount, which is huge. Okay, we don't have the same currency volatility in the developed markets, even though it's getting higher, but it's not that higher when compared to emerging markets such as LATAM. So Brazil real 16%, one of the most volatile currencies in the world. Colombian peso 15%, Chilean peso 12%. Okay? So all these major Latin currencies shows higher volatility, and high volatility can translate to higher currency risks. So this is the idea. So because that is so important, business with exposure to FX risks to have a very solid FX risk management program. The main goal is to reduce this currency volatility in order to reduce the fluctuations in their cash flow. Pretty much this is the idea. The essence of the currency risk is to reduce the currency volatility over the time. Okay, so when we reduce the volatility of the currency in your cash flow, you have more stable revenues, you have more stable liabilities, because you don't have more higher impact of the currency on these exposures.
So when I think about and understand all this complexity in Latin America, are corporations not just tempted to say, okay, well, I'm just gonna deal as much as possible in dollars? You mentioned, I think Ecuador started using the dollar as one of the main currencies, right? I believe Costa Rica is the same. Is it a possibility for corporations to just say, okay, guys, if, I don't know, 90% of my suppliers are anyways not Latin America based, but will probably accept dollars, let's deal like this and try to convince my customers to also deal in dollar? Is it a practice in Latin America or not at all?
Yeah, this can be done. This can be done. We have seen many corporations adopting this practice. What they are trying to do is to seek a natural hedging. So their supply chain is in dollars, their buyers are in dollars. So we don't have any currency risk, any currency mismatch. So this is a good price, but not always this is possible. Not always this is possible. But when this is possible, of course, it's a good strategy, because we don't need to build a hedging problem to address the currency risk. We don't need to build an in-house team or outsource this hedging to a FX risk consulting company and so on. It has good advantages, but in some cases you don't have this opportunity to do that, or your customers are not be happy with this. They want to pay local currency. They need to pay in the local currency. So in order to gain competitiveness, you need to work with the local currency of the country. A good example of that is SaaS companies. When they try to be more international, they want to commercialize them to sell their SaaS software, their SaaS product in other markets. They need to charge the client the license of the product in local currency and not in their basic currency, the reporting currency. Okay, so when they charge their customers in local currency, generates the currency risk. So they need to manage this currency risk.
Has FX hedging changed over the years? Like, so options aren't a new technology or a new, let's say, financial tool. Technology has changed quite a lot, nonetheless, though, over the last 10 years or so. How have you seen the evolution of just hedging as a technology or as a strategy become more complex or versatile or adapt or progress over the last?
That's a good question. So what is that? So a good example of this movement towards innovation is the agro. We are not a traditional FX consulting firm. We are using a lot of technology in our approach regarding currency risk. We are adopting a lot of machine learning, Bayesian regression, and now AI in your tools. So the idea of the agro is to take a more holistic approach to FX risk management, in particular in emerging market currency, due to all the effects that I mentioned here, volatility, interest rate differential, in order to provide a more tailor-made solutions to our clients, and always using technology. This is the idea. So because that, I don't like to say that we are advisory. We lean more to be a fintech. Okay. So this in the last 3 years, we have been developing a couple of tools that right now is in a platform web-based where our clients can access and use our tools there. So there are many things that the users can do in your platform. The first one is to get access to market data, trends, analysis to take a more FX decisions. They are able to use Monte Carlo simulations, which is a very sophisticated statistics technique to model potential outcomes of the currency pairs. He is able to incorporate inputs like volatility, skewness, amount, maturity, and the platform will bring different outcomes because different market conditions. Because as you have flexibility in the inputs, like change the volatility, change the skewness, you are able to create different market conditions and analyze the performance of different hedging programs in such environments. So most of the time we create the clients create 3 market conditions: worst case scenario, neutral scenario, and best case scenario. So through the platform, he's able to see, okay, this hedging strategy performs in this way, in this environment, in this one. So, okay, I need to protect against the worst case scenario. So I want this one because my risk profile, I have this profile. So this one is the best hedging strategy according to my risk profile. So in this way, he can see the statistical evidence and take a more formal decision. The bigger it is to remove the emotion of the trader, remove the emotion of the treasury team in terms, okay, I need to use an ETF, or no, I need to use this because the market goes to 7, 8, 9. No, the idea is not that. The idea is to remove this and apply more data-driven decisions into the treasury team. So this is the idea. So using this innovation, using this new approach to FX hedging, the clients can put more solid hedging programs in place, be able to maximize the upside participation, these hedging programs, able to reduce the downside risk considerably. And in the end of the day, doing all this with a lower cost, because he is optimizing all the steps to build their hedging structure.
So technology overall, such as edge computing, the rise of fintechs and whatnot, would you say that's the biggest change in FX risk management over the last decade?
Yeah, I'd say. And right now with AI, I think things will change completely. We are seeing more and more companies and also FX specialists adopting AI to run analysis, simulations, and the good stuff that we can, all the technology can expedite the hedge analysis. This is the build. You can expedite the analysis and be comfortable with the results. The accuracy of the numbers of the results is much higher when you have a machine running, you have an algorithm running the simulations, rather than some member of the company doing Excel, spreadsheets, endless data to analyze, etc. So I think machine learning, AI, all the technology, all the developments in this area is towards how we can create better FX risk management strategies. More accuracy, I think the word is accuracy. How to reduce the noise in this analysis. How to make sure that that strategy will work in that specific country, which has that specific nuances in terms of volatility, interest rate differential, hedging cost, liquidity of the instruments, etc. So using this technology, we'll be able to put together much more solid FX risk management programs.